Thank you very much, everybody, for joining for our second day. And we know it's 8:30, might be a little bit early, so I hope that one or two will still join. I don't want to spend too much time for the introduction. Maybe just to remind you that we have a Slido and you have the information in the chat. The code is 1869 to put your questions, then we can use for the panel discussion. So Florian, can I hand over to you for the presentation?
Sure. So let me share my screen. That should be it. So let's move back to. So thanks for having me. This is an interesting topic, but when Florian Regli approached me, the question for me was really, why do we worry about taxes in the context of sustainable materiality? Sustainability is actually something we think about a lot. As Jay Zafarzardin, we only do sustainable investments, and we've been doing that for 30 years. So we've been thinking about the topic of sustainability and what is material and what is non-financially material for 30 years, and we probably have a slightly more nuanced view on that than some of our competitors. But still, I hadn't thought about much about taxes in the context of sustainable materiality before. Not probably in a structured way we did, but I'll show you some of the stuff we've done. So it was an interesting question. But I think before we start out, let's start with the obvious, was that taxes are material and always have been material. Right, so if we go into the next slide, and then again, Florian Regli in his introduction yesterday made fun of me for presenting corporate taxes this way, but I did it to make them comparable for the two charts that I'm showing here. What I'm showing is, one, the taxes on corporate profits as a percentage of GDP in Switzerland, and I just chose Switzerland because that's where we are, over the last several decades, and the same thing as percentage of revenues, income taxes as percentage of revenues. And the other caveat I think that is relevant here in this discussion is, what we're talking about is only corporate taxes. And corporate taxes is only a small part of the tax base of any nation state, right? The value-added taxes, the personal income taxes, and then their corporate taxes. And in general, corporate taxes are actually the smallest part of the tax base of any nation state. But having said that, as a financial analyst, this is what I'm mostly interested in. And so the corporate taxes have always been material to the financial analysis of companies, but it wasn't something that we were hugely worried about historically. And there are three reasons for that. Number one is, as you can see on this light blue line that I'm showing here, they don't move profit margins a lot, right? They sort of are between 2 and 2.5 percentage points. And so they're not hugely impactful or hugely volatile over time. And I mean, if you have, let's say, a 10% pre-tax profit margin and your tax base goes from 20 to 30%, which would be, your tax rate goes from 20 to 30%, which would be the usual way of thinking about taxes, that moves your net profit margin by 1%. But obviously a move from 20 to 30% is a huge move on the tax rate, but it's just a 1% margin move on the company. So that's why that's why financial analysts sort of think about it, but we don't spend huge time on this. And lastly, we actually get good guidance from management what future taxes will be, right? So from that perspective, they are reasonably easy to model, right? And since we're predicting the future, if something is easy to predict, then we don't spend a lot of time thinking about it. However, there are outliers. And this is where it gets a little bit more interesting. This is obviously a comment on the average, but as everywhere, we have outliers in either direction. So let me show you some of the outliers that we're having. What I'm showing you here is for the companies in the SMI. So for all the non-Swiss, the SMI is the index of the 30 largest companies in Switzerland. And what I'm showing you here is the net tax and the gross tax position. So the net tax position is really, deferred tax assets minus deferred tax liabilities. And the gross is then deferred tax asset plus deferred tax liabilities. And I show these as a percentage of equity to normalize them. And as you can see, Swiss Life has about 15% of their equity in tax liabilities, net tax liabilities. And so that seems like a reasonably large amount, and it might be something worthwhile looking into. On the other hand, Novartis and Swiss Re, they have huge tax asset and tax liabilities. They're offsetting each other. But again, there might be something in here which we might want to have a look at. Why is that the case? And could that impact future profitability? Or is there a risk that this could impact future profitability? So let's have a quick look at Swiss Life, which I used as the example how we would go about. And there is actually some decent disclosure, right? And we'll talk about the differences in disclosure under IFRS and GAAP. And I'm part of the Capital Markets Advisory Committee of the IFRS. So I actually do also spend a lot of time thinking about these types of differences. But this is at the bottom of the slide, you see the deferred income tax asset and liabilities disclosure of Swiss Life for the year 2020. So this is annual report 2020. And what we can see is they're negligible tax loss carry forwards. They're really very small differences in the effective tax rate and the weighted expected rate. That is an additional disclosure, which I'm not showing here. But they have huge tax liabilities arising from non-realized gains in the investment portfolio. Right? So obviously these are insurances. You know how insurances work. You pay them premium and you hope at some future point they pay you back if you have a loss. And the insurances during that time take your money and they invest it in financial assets. And as we also know, interest rates have gone down, so bond values have gone up and equity markets have gone up, so equity values have gone up. And thereby Swiss Life sits on huge non-realized gains in their investment portfolio. If they would realize those gains, that should then result in higher future income and thereby higher future taxes. And this is where these future tax liabilities come from. So as a financial analyst, I need to think about how will these assets be realized? Over what time frame shall we get that at additional profits in the portfolio through the realization? And then that will be taxed as well. But this is some way how we can think about using tax disclosure and think about how that would impact future liability. And it's just one example. I'll show another example later. But so far, all we've talked about is, normal financial analyst toolkit. This is nothing out of this ordinary. This is just normal stuff we do all day and have been doing for the last decades. So why are we still talking about taxes in the context of sustainability? Why is that a relevant discussion? We've had some examples from Dr. Pohl yesterday, why that is starting to rise in the international discussion. And I think the underlying discussion is, what are fair taxes? So let's have a look at the data again. And let's think about what are fair taxes. What I'm showing you here is I've taken the 500 biggest European companies. I've looked through the years 2015 through 2019, which I thought is a reasonably fair representation of a business cycle. Obviously, 2020 was a weird year. And I've showed how much they spent on different stakeholder groups. You know, how much did they spend on the personnel? How much did they spend on management salaries? How much in government taxes, and how much did accrue to shareholders, either through dividends or share buybacks? And just as an aside, you know, we talk about salaries and management salaries in the context of sustainability a lot. Just again, on the big picture, the sliver of management salaries is so small, you really can't see it here on this chart. It was 16 billion over the 5 years. But obviously, 16 billion is still a very large number, 16 billion euros, particularly if you sort of distribute it of only over a few thousand people, right? So for the individual, you know, in nominal terms, it's a huge number. But for us as financial analysts, in the grand scheme of things, it's not that huge a topic. We are more worried about alignment of incentives and governance structures and these types of things, not the absolute numbers. But let's come back to taxes here. The question if this pie is fair is a discussion I can't answer. This is a moral discussion that has to be resolved through political processes. And we've had some discussion yesterday in the first presentation here around that, how these political processes work. My personal concern here is that the issue is around extraterritoriality, right? How much can we as an international community claim to know what is fair for any given sovereign state? Because each sovereign states, through their own political processes, agree on what are fair taxes. So let's take a very concrete example. So I live in the canton of Schaffhausen, which is not too far from St. Gallen, in the north of Switzerland. And there we have a department of the canton, which is called Wirtschaftsförderung, which negotiates tax deals with companies. So they, locate their headquarters in Schaffhausen. You might argue, well, this is unfair. This is an unfair competition by the canton of Schaffhausen. But we actually had an explicit referendum on the topic of what is the mandate of the Wirtschaftsförderung. And there was an explicit agreement on the mandate of the Wirtschaftsförderung. Now, if you start saying, well, their behavior is unfair, you question the political sovereignty of the canton of Schaffhausen. Because the polity of that canton, this Land would be the German equivalent, the Bundesland, has decided that that is the way to go. If the nation state of Ireland decides that low corporate taxes are a brilliant idea because it attracts thousands of high-paying Google, Facebook, and Amazon employees, which you then can tax on their income, and the rest of the income they spend on food and housing and entertainment and create all sorts of other jobs, well, maybe that's a very good decision for the nation of Ireland. You might not agree with the fact that 10% is too low or whatever the statutory tax rate is, but it's kind of hard to argue that the political process that that went before that decision to set that corporate tax rate was not fair. And I think this is where this whole discussion kind of runs into difficulties. Because the whole discussion of what is fair and what is sustainable is fairly nebulous. And obviously the tax lawyer's view yesterday was very clear that that is a bullshit statement. Not his words, but mine. But so that makes this whole discussion very difficult. There's a different aspect to it too, and we're talking about corporate taxes here. So 30 years ago, I was trained as an economist, and most of you are probably too young to remember, but back then we had a public policy doyen in Switzerland called Walter Wittmann, and I trained under him, and we talked about this topic a lot. The problem is corporate taxes are a very blunt policy tool. So if we look at the next slide, I'm trying to give you an understanding of why that is the case. So on the left-hand side, I'm showing you, and this is for the US, per decade, what was the average statutory corporate tax rate and what was the productivity growth of the non-financial sector in percent during that decade. And if you just look at that, you'll find that actually it seemed like higher tax rates resulted in higher productivity growth, which is kind of nonsensical from the perspective of how we would think about it nowadays. The example, and it's a counterintuitive outcome. And the reason for that is because there's all sorts of other things happening, and corporate taxes aren't that important in directing corporate flows or corporate investment decisions. The same can be seen in Switzerland. On the right-hand side, I've shown you tax on corporate profits as a percentage of GDP, and then gross capital formation in the subsequent years. Right, so if we lower corporate taxes, do we then get higher gross capital formation in the following years? And this isn't an academic study, but just prima facie, it's not clear that that is the case. And let me just give you a last example on that. We actually had an event study on this, the Trump tax cuts, which we saw in 2017, 2018. And let's see what happened there. So this is all the companies in the MSCI and how they spent their cash. So this is cash flow statements of all the aggregated cash flow statement of all the companies in the MSCI US. And I'm showing the numbers as percentage of operating cash flows. Right, you generate some cash from your operations, and then you think about how you want to spend it. And what happens is that the line at the very bottom, those is what is spent on cash taxes. And obvious, as you would expect with the Trump tax reform, the amount of money corporates needed to spend on taxes went down. What went up to offset that was actually share buybacks. The fixed asset investment line really didn't move. So what really happened through the Trump tax reform, contrary to what a lot of the proponents claimed ex ante, was taxes were just, the less was spent on taxes, that was just handed over to shareholders, basically. Right? All I'm saying here is it's really hard to know what are fair taxes because there's a lot of sovereignty issues involved in here. And as a policy tool, it's a very bad tool to do to structure macroeconomic policy in the first place. Why are we still talking about taxes as an issue within sustainability and being financially material under sustainability heading? Well, the discussion around what is fair taxes is continuing, and as the way it looks, we've had that the BEPS initiative by the OECD will probably result in significant shifts in how taxes are being evaluated. So how do I think about that as a financial analyst? How can I evaluate that risk? What I'm showing you here is for a whole bunch of companies out of the MSCI, I'm showing you the estimated statutory tax rate on the x-axis and the estimated effective tax rate over the past 5 years. So there's some averaging in there for all these companies. Now, if I think about the BEPS goal of having a minimum tax of 15%, anybody below that 15%, I think I need to have a look at it because maybe that is not sustainable. And all of those which are at the lower end, where I've said riskier, they are at risk anyway because they're paying way less than what would be expected if we would apply the statutory tax rate. I know the statutory tax rate is not a really good idea because there are a lot of loopholes. Tax accounting works very differently than GAAP accounting and all of that. But let's use that as a proxy. And I think it highlights some of the issues that we're having. What you're seeing here is, you remember my second slide, Swiss Re and Novartis, the guys with the huge gross liabilities, they're down here as well, and they would be screening as having a riskier tax position, right? And that would be the point where I would have to engage with management and talk to them and say, listen, guys, particularly these two names who claim to be very sustainable, I think we would have to have a chat with them about their sustainable tax policies and why, they think the taxes they're paying are, sustainable not in the sense that we generally use the word in these discussions, but as in, how sustainable are they on an ongoing basis? The interesting thing in this analysis is that a lot of the US companies don't actually stream that badly, right? I've highlighted Apple in here, which normally gets a lot of bad rap in that context. But there's actually a reason for that. And so as my last example, I've brought along the financial analysis of the tax reporting of a company everybody loves to hate these days, and that is Alphabet. Now, the US, part of the US tax reform, there was something in there which runs by the abbreviation of GILTI. Right? I love these abbreviations from the US guys, right? So guilty, but without the U, brilliant. But the idea with guilty was that they want to make foreign tax shelters less attractive. And as we all know, the US has very little difficulties in expanding their laws extraterritorially. Right, they're happy to have their laws apply basically all over the world. Foreign Corrupt Practices Act is one of those. But obviously their tax laws is the other example. If you know anybody who has a US green card and lives in Switzerland, he'll probably tell you how much he spends on tax lawyers trying to figure out his US taxes. So what GILTI does is that it says, listen, on the taxes which you derive from foreign income, you need to pay 15%. And so the added disclosure we get due to GILTI, and then GLOBE is really part of the BEPS discussion, where they say we should have a 15% minimum tax rate. So if we look at Google, we find that they have shifted a lot of their pre-tax profit domestically. So whilst in 2018, they made more pre-tax profits in foreign jurisdictions, by 2020, they have shifted most of those domestically, right? On the domestic pre-tax profits, they pay a tax rate of 17.1, which obviously is way below the statutory rate, but then the statutory rate would be 21%, but then obviously tax accounting and deductions are very different from GAAP accounting. But let's assume that 17% is at least a legitimate number. Then we can have a look at their foreign pre-tax profits and how much they paid on that. And that is sort of the third last line in the table on the left-hand side. The tax rate on their foreign profits went from 6% in 2018 to 13.7% in 2020. Now, if I would assume they would have to pay 15% on foreign taxes, that would add just another 200 million, which obviously for a company, 200 million would be a lot of money for me. That much is clear. It's not as much money for Google, to be honest. So it really changes. So moving the foreign taxes taxing the foreign profits at 15% would impact the profit margins by 10 basis points, which is negligible, basically. And what we have seen is that due to the GILTI reform, a lot of US companies have moved the taxes, have moved the tax base into the US. Right? So for example, at this point in time, Google doesn't have any significant foreign subsidiaries anymore. They list 3 significant subsidiaries in their report. I think it's appendix 21.1 of their 10K. All of them are in Delaware. Historically, they had a few in Ireland, but those aren't significant anymore, right? So that's why they dropped out of the disclosure. This is a way we can think about, as a financial analyst, what would be the impact of BEPS and the underlying globe discussion on the profit margins of the companies we're looking at. We can then always go down further, and this is in another disclosure we get from Google, where they have to have a transmission between, well, what is our federal statutory tax rate, and how much am I paying in as effective tax rate, and what are the key differences between those two numbers. And that is a table that is part of the required disclosure so both how much is domestic and foreign, as well as this transition from statutory to effective, those are required disclosures under US GAAP. And so we can look into this and then say, okay, even now with a 13.7% tax rate, they still have, a few percentage points on their foreign income tax at different rates, which maybe could be a future liability, a future risk, right? And so we could drill down a little bit further, and if I would feel like it, have that discussion with Google management. But this is how we can use the existing disclosure to think about what are the risks from the ongoing discussions, BEPS, around what are fair taxes and how should tax burdens be shared. IFRS disclosure isn't as far, so we definitely don't have the domestic versus foreign. We sometimes get this transition. We have a lot of the details on what is deferred tax asset and liabilities, as I've shown in the Swiss Life case, which is an IFRS reporter. But it would be useful if we kind of move more to the US GAAP disclosures. But I think, and there I agree with the discussion yesterday, a country by country disclosure is just ridiculous, just basically impossible, to be honest. And I don't think very fruitful either, not very insightful, outside of random tax shaming discussions. So, I'm just at the end. So let me just close here. I think, again, taxes have always been material to corporations. Their analysis has always been a little bit of a black box, but so far we haven't really worried about it because they weren't a big issue and they were fairly persistent over time, and we got good guidance. This increasing discussion about what are fair taxes introduces an incremental risk, which we need to worry about. And this is where, as financial analysts, we need to think about more, how can we analyze the risk between what is our effective tax rates versus statutory tax rates. And there we get into the discussion of differential disclosure, US GAAP better than IFRS, and then obviously some of the disclosures required by GRI that were discussed yesterday would enlighten us maybe, and I say maybe, a little bit further, but that's about it. With that, thank you very much. I am just 1 minute over, so apologies for that. And I'm looking forward to your questions during the chat.
Perfect. Thank you very much, Florian, and no need to apologize. We started 3 minutes late, so you're actually 2 minutes early. Thomas, any comment from your side?
No, I think we can ask our question. There's so much food for thinking in the panel session. It was very, very interesting. So just to the participants, if you have your questions, please use Slido or otherwise raise your hand during the panel session. Okay, thank you.
And good morning, everyone, also from my side. I'm happy to share the insights of the S&P Global Corporate Sustainability Assessment on tax. First of all, a big thank you also to Florian Esterer and Dirk Pohl for their presentations this morning and yesterday in the afternoon. I found them very interesting, and I'm looking forward to the discussion already now. So without further ado, maybe just a few words about myself. So my name is Sebastian Saner. I'm a senior ESG benchmarking specialist with S&P Global. I have been with the company for about 4 years. I have a background in economics, and before joining the company, I've worked in economic research and as a consultant for one of the big four. Quickly about my role. So I'm not an analyst. My role is not to assess companies and give them a score. I'm part of a benchmarking team. And what we do is we provide a variety of services that help companies better understand their ESG performance and benchmark against peers. And we make use of CSA data, but we also integrate other data sets and other information. So what's on the agenda today? Quickly, just for those of you, well, sorry about that, for those of you that are not familiar with S&P Global, I'm just going to quickly give an overview and talk about the ESG offering. Then I'll give you some background on the corporate sustainability assessment. And last but not least, I'm going to deep dive into the tax strategy criterion, which is part of our assessment. So S&P Global has 4 divisions. You can see them here. The Platts division offers services to the energy sector. The S&P Dow Jones Indices division is known for its financial indices, such as the S&P 500, for example. The Market Intelligence division offers or delivers intelligence services to financial market participants through our own platforms, but also through data feeds. And of course, most of you are familiar with our ratings division, which is known for its credit ratings. And in all these divisions, we also have an ESG offering. I just quickly want to talk about Dow Jones Indices. For those of you who are less familiar with the history of the CSA, it was actually introduced and founded by a company called SAM, a Swiss-based asset manager. And that was in 1995. And about 2 years ago, S&P Global acquired the business unit that managed the CSA. But it's not that we only started collaborating with Dow Jones Indices 2 years ago. In fact, the collaboration dates back to 1999, when we came together and created the first best-in-class ESG index. And this has become translated into an index family, the Dow Jones Sustainability Indices. And by now, of course, we're expanding the offering in this area. We now offer climate indices, thematic indices, and so on and so on. The Market Intelligence division, of course, also makes use of the scores and the insights that we derive from our assessment. So most notably, the S&P Global ESG scores, formerly known as CSA scores. And we also show other insights that are created by another business unit called TrueCost. Also, the ratings division has some ESG offerings. There we offer corporate level analysis, but also external reviews and second-party opinions, for example, on frameworks like a green bond framework. And we also issue evaluations on a transaction level. So that was just a quick overview, and some of you may have noticed this logo on the top right-hand side, a sustainable one. It's a new cross-functional unit that we've introduced a couple of months ago with the goal to centralize all the, say, ESG knowledge and know-how, and to basically feed it to all the different divisions for their offering. So that brings me to the CSA, as it's of course part of this cross-functional unit. So what is the CSA and who fills it out? Basically, the Corporate Sustainability Assessment is an annual evaluation of the world's largest companies. So we have about, so last year we had 1,400 companies that proactively completed the 2020 CSA, and they represented about a third of global market capitalization. So some might refer to it as a questionnaire, but actually for most of us, it's much more than this. It's a reference tool. So it's a reference tool to assess company sustainability performance from an investor's perspective. As I just mentioned, SAM, basically the company that founded the CSA or introduced the CSA, was a Swiss-based asset manager. And we kind of have this thinking embedded in our methodology, and we had that from day one. So it's also a reference tool to prepare for upcoming sustainability trends. The CSA has a track record of introducing topics before they were on the agenda of, say, mainstream investors. And last but not least, it's a user-friendly platform that helps companies engage all their peers, their internal peers. So, for example, a sustainability manager can, dedicate certain sections of the CSA to a topic owner, like an environmental specialist or a investor relations specialist, and they can then, take care of the respective sections that that they know most about. It's an industry-specific approach, so we differentiate between 61 industries, and for each these industries we have a slightly different assessment, but for all of them we analyze the performance in the 3 dimensions: economic, social, and in the environmental dimension. The methodology is adjusted on a yearly basis, proactively and reactively, to adapt to, and reflect recent trends in corporate sustainability, but also to capture future opportunities, and in some cases also to align with other reporting standards. We consider publicly available information, of course, but companies can also engage with us and provide additional information. So that's the 1,400 companies that you have in the title. And we've actually seen that this number has only gone up, more or less, over the last 20 years. You should also keep in mind that we've actually kept the number of companies that can provide information due to certain capacities, reasons. But this year, we've actually opened it up to many more companies. And for 2021, I would have to adjust the y-axis here, because we've had already more than 1,800 companies that have actively participated in the CSA this year. So it's only going up. And last but not least, the process is also third-party audited. So let me give you a bit more information about the methodology. This is a visualization of the CSA. You can see in the center, there's the overall S&P Global ESG score, which is based on 3 dimensions: environmental, governance, and economic, and also the social one. Then these dimensions are built on different criteria. On average, we have about 23 per questionnaire. And these are then again, consisting of about 3 to 5 questions, gives an average of about 100 questions per assessment. And these can then be, translated into 1,000 different data points. And you see that for one S&P Global ESG score, we aggregate a lot of information, up to 1,000 data points. And of course, the question is, what are these data points and how do we weight them? And this is where our financial materiality framework comes in. So for each industry, we ask ourselves, what are the key value drivers? And what are the ESG factors that could impact these value drivers? And when I talk about value drivers, I mean, for example, the company's risk profile, potential of revenue effects, and also profitability. So for example, through cost structures. And of course, this methodology has been reshaped over 20 years of sustainability investing, and it's been adjusted, as I said, on a yearly basis. And you see that these boxes, or these these blue areas, they're not the same size, and that's kind of to show that the weighting of these criteria can also differ. And this brings me now to tax strategy, because tax strategy is one of these boxes in the third layer. It's a criterion in our assessment, and it can be found in almost all assessments. So in almost all industries, we're looking at tax strategy. It's generally not the most heavily weighted criterion, so it has, let's say, an average weight of about 2 to 4%, but still we consider it relevant in our assessment. So before I go into the details on tax strategy, let me take a few steps back. I think starting from the 80s, we have seen a lot of movement when it comes to corporate income tax rates, and in fact, we've seen increased competition between territories, and we've also seen the emergence of, in some cases, quite sophisticated tax avoidance strategies. And reinforced by digitalization, this has kind of led to a race to the bottom, as Janet Yellen has recently put it. She's the US Treasury Secretary. And a recent OECD study or estimate found that annual corporate income tax loss amount to about 100 to 400 billion US dollars, and that's about up to 10% of global corporate income tax. So it doesn't surprise that there's many national but also multinational initiatives to address this. And I've noted a few here. For example, in 2015, the OECD G20 introduced 15 action plans to prevent so-called base erosion and profit shifting by multinationals, with the goal to basically give or equip governance with the tools to tax revenues, or to tax profits where value is generated. So these action plans, they've actually been adopted quite widely. So I think only over 90% of or 95% of global economic activity, so I think that's about 116 countries or so, have adopted these action plans and are using these tools to inform their tax departments. But that's not all, of course, and it's not perfect by far. And I think one of the reasons why we're here today is this third bullet point. So only a couple of weeks ago, the finance ministers of the G20 introduced new plans of a global minimum tax of 15% for large multinationals, and a shift to pay taxes where revenues are generated. So also these plans are far from being implemented, and we know that there's already some thresholds, and some industries will probably be exempt from these rules. But still, when we look at the big picture, I think we can all agree that there's a lot of movement in this space. And therefore, we have to ask ourselves as an ESG rating provider whether this can somehow affect companies' value drivers. And we came to the conclusion that indeed, this is something that we should consider. Most of all, because we think it can affect a company's risk profile. And when I talk about risk, I would say there's two risks. On one hand, there's reputational risks, but there's also regulatory risks. And maybe I'll give a few examples here. So in times of global issues or global crisis, the question is always raised whether large multinationals are also paying their fair share, whether they're not just contributing to the economic development, but also to the social development in their host countries. And particularly during times like a pandemic, these questions are asked, and companies are under increased scrutiny if they ask for state aid during like a pandemic, during a time of crisis, but then when things are going better, things are going well, they're trying to shield their profits. So that's an issue that we see, and companies are under increased scrutiny for such practices. Another point to consider is that global sustainability strategies are also more and more assessed from a holistic perspective. That means, for example, it's not enough anymore to just do one thing right. You have to look at the whole picture. So, for example, many companies are or have introduced policies to ban child labor in their supply chain, and that's definitely something positive. The thing is, if at the same time this company makes every possible step to shift profits away from a host country where this child, could have potentially worked, then the question is raised how that host country is going to pay for, their infrastructure, for the school that the child is supposed to visit, or the school bus that the child is supposed to take. Now, obviously, these are simplified examples, and it doesn't, there's no direct effect, but it just shows that companies cannot just do one thing right and do the exact opposite with the other hand, basically. But more interestingly, I think, and potentially more impactful, are the regulatory risk. And I've mentioned this plan to introduce a global minimum tax of 15%. And I think these would indeed increase or basically put some of the profitability of companies at risk. And it could also affect the long-term outlook of the company. So this is something that investors care about. And this is why we believe we should have a tax strategy question or criterion in our assessment. So we have introduced the tax strategy questions first in 2014. The criterion consisted of 2 questions back in the time. The first one was tax strategy and governance, so policy-related questions, where we're still looking for an official stance from the company, how they manage tax issues and their approach to certain tax practices. And then the second question is on tax reporting, where we've been asking for disclosure on 3 key issues or 3 key metrics. That's revenues, profit, and taxes paid on a country-by-country level, but also on a regional level. That was back in 2014. In 2018, we've introduced the 3rd question, which is looking at the effective tax rate and the cash tax rate paid by companies over the last 2 years. And then last but not least, we've updated the criterion this year. So let me give you some insights on the scoring. So this is the criteria scores that from 2020 to 2021 criteria scores are still being finalized. And the picture that we see is relatively consistent across the 3 underlying questions. So this is the aggregation of the 3 questions. We see that North American companies, they score lower, especially compared to Asia Pacific and Europe. Asia Pacific and Europe, they score higher on the policy-related questions, but also on the effective tax rate question. Emerging markets somewhere in between, but they actually score quite well when it comes to disclosing. So that means tax reporting. So let me go into the details of the first question. I see we only have about 7 minutes left, so I'm going to be a bit quicker on these. So basically, this first question, we're interested if a company has a publicly available group-wide tax policy. I'm already looking forward to the discussions that we may have in the panel, as there's been some quite juicy comments in this morning. So we want to know whether companies commit to spirit and the letter of the tax law, whether they can commit to not to transfer value to low tax jurisdictions, whether they make use of tax structures without any commercial substance. Transfer pricing is looked at, whether they make use of secrecy jurisdictions. And last but not least, we're also interested to know if this policy has been approved by the board or if the board has been somehow involved in this process. Some statistics. And I'm now looking at our core universe of companies. That's 2,500 companies that we've assessed for the Dow Jones Sustainability Indices. We see that about a quarter of the companies that we've assessed, they actually have such a global policy publicly available. And of those that have it available, we see that almost 80% commit to compliance with the letter and the spirit of the law. There's also a relatively high share that commits to transfer pricing using the arm's length principle. And there's fewer companies, about a bit more than half, that commit not to use tax structures without any commercial substance, or just general, they're just generally committing not to transfer value to low tax jurisdictions. Statements on the usage of tax havens are a bit less common. Maybe that has to do with the sometimes unclear definitions of what is a tax haven, but still we see that about 40% proactively commit not to make use of such secrecy jurisdictions. On the reporting side, this is a question that was updated. So as I mentioned in the beginning, we just used to look at 3 indicators: revenue, profit, and income tax paid. Now we've expanded the catalog of metrics that we'd like to see reported, and we've also moved away from the regional reporting. So now it's only country by country reporting, actually. So loads of these aspects, I think they're quite familiar. If you, for example, have seen the OECD guidelines or also the GRI, this is a subset of the indicators that they're looking for. Some statistics on last year's results. We see about a third of companies that are not reporting this information proactively, and not at all. Then we have another third that is reporting on at least one of these metrics on a regional level. So that was still possible last year in our assessment. And we see a third of companies, so a third of 2,500 companies, that are already breaking down their key tax metrics on a country by country basis. The last question on effective tax rate asks for the reported tax rate and the cash tax rate for the last 2 years. So what we're looking at here is basically we're comparing these tax rates over time, and we're comparing them across the industry. And we also allow for some explanations or reasonings why the tax rate might be below the industry group average. So for example, if you've had any net operating losses, if you're just active in one single jurisdiction and that jurisdiction happens to have a low tax rate or low statutory tax rate. We can also consider if there's been any one-off losses, if there's timing issues, etc. But in general, the idea here is to compare the tax rates, the effective tax rate and the cash tax rate. And similar to Florian Esterer's slide here, I've just done a quick and dirty back of the envelope comparison, and I found out that about 20% of companies actually had an average reported tax rate below 15%. It's even a bit higher in the US, where it's about 25%. And in fact, the majority of companies are somewhere in between the 15 and 20%. So it will be interesting to see how these companies that have consistently had rates below the 50%, how they would react to an introduction of this global minimum tax rate. And I'm sure investors would like to know which companies these are. And as Florian Esterer has explained, they would like to address this then in a meeting. So I've been actually quite on time. I would have loved to take a bit more time, but I guess we'll have the opportunity to talk about this in the panel. This is the disclaimer, and I look forward to the discussion. Thank you.
Perfect. Thank you very much, Sebastian. I would propose that we just start with the question of William Jan. I was informed yesterday by our assistant that he already raised the hand yesterday, and I was too fast closing the discussion, so apologies for that. But Dirk Pohl is also joining today, so if your question is still in your head, please go ahead.
Yeah, thanks for that, and no worries. It was just an addition to presentation of Dirk yesterday that in the last compromise text for public CBC, companies are also obligated to report on countries on the grey list. So it's not only the black list, but also the grey list. So yeah, there has been a long political debate on public CBC, countries in favor and against. So that yeah, that has resulted in that compromise text. But actually, my question was for Florian on the really interesting presentation. Also from a policy perspective, really interesting to see how financial analysts are looking at corporate income tax, and also that it is a blunt policy tool. Yeah, I think you said that the US GILTI rules have resulted in onshoring of income to the US. The OECD is now proposing Pillar 2, which resembles the US GILTI rules. But contrary to the US GILTI rules, Pillar 2 is based on CBC. And I think you also said that CBC data is not that helpful from a financial analyst perspective. So I know it's a complicated question, so I understand it if you don't have a clear answer. But yeah, what do you think? Will Pillar 2 result in incorrect conclusions and incorrect levies because it is based on CBC data?
To be honest, I really don't know. Right, because I haven't really looked at it in sufficient detail to make up my minds. I think there's just too much going. I mean, if you talk to the tax guys from any corporate tax department, they'll tell you there's just too much going on for any of this stuff to be really helpful. Because it's not, I mean, again, it's not the statutory tax rate that is relevant, but you have all these, you know, we've had I showed you the large gross exposure from Swiss Re. They just have tax loss carry forwards, right? And they can use them. There are lots of deductions. There's lots of other things besides the statutory tax rate, which will move your effective tax rate without the effective tax rate being illegitimate. Right? I mean, we need to understand, right, that the tax, I mean, most of the tax rates these guys are paying are legitimate tax rates. I think this was the point that Dirk raised yesterday, right? And simply because we have a difference between effective and statutory doesn't mean it's illegitimate, and it doesn't mean it's immoral, right? And thereby, I'm not sure that the country by country disclosure is really helpful, because I don't think it helps me solve these types of questions.
Yeah, no, I fully agree. I think also the point I made on the first day is that loss carry forwards are not taken into account in the CBC report. So that leads to deviations. Okay, yeah, thanks for that. Really helpful.
So,
anybody else with a question or a comment? So Thomas, you?
yes, thank you very much. Coming more from a financial perspective, doing financial reports, financial analysis. My questions maybe to Florian, and also to Standards and Poor's. Do you think that the companies manage their ratings, their sustainability information? I mean, from the financial perspective, we know we have the aim in the company to be, for example, investment grade, things like this, and you manage your numbers, you have a kind of earnings management, you have an equity story for your investors. Is it the same with sustainability information? The companies really manage them and try to reach a special kind of rating in this, or to be a sustainable investment grade? What is your idea about that?
Sebastian, you want to start?
I'm happy to take that one. So I wouldn't say will actively manage, but evidently every company wants to show its best side, for example, when being audited or when being assessed on any set of criteria, I'd say. And of course, there is a lot of demand these days. If you've looked at, you know, recent statistics of sustainable investments and how they have skyrocketed, obviously companies kind of feel the need to disclose more information and yeah, to come away from like a black box and to help investors understand what their processes are, what their strategy is on certain issues. And this is, of course, also something that we as a rating agencies make use of to help refine our ratings, and therefore, well, I wouldn't say, yeah, I guess to some extent they are investing resources in this space. Yes.
Now, my answer is, and obviously I see it from the other side, but so I agree with Sebastian that they're investing resources in this. And I think they should be investing resources in it, but for very different reason than Sebastian. There's a huge difference between credit ratings and sustainability ratings. The credit ratings align 99% of the time. The sustainability ratings of the different rating providers align very rarely. There's a brilliant article by academics from MIT and Zurich. It's called Aggregate Confusion. If you ever get the chance, please read that article, because it basically shows that the different rating providers can't agree on what is sustainability. They can't agree on what the criteria are. They can't agree what how the criteria should be weighted, and they can't even agree on how to interpret the different criteria. So if you, as a company, try to manage that, you have 4 or 5 different targets for the same thing. It's just impossible. The problem with the sustainability rating providers is that they, after, you know, Sebastian said that they've been working on this for 20 years. They haven't done a single study where they showed that the criteria they're using has any measurable impact on the financial accounting performance of the companies they're rating. You know, we have some studies from Zerafime out of Harvard where he actually looks at financial materiality, in particular of the SASB criteria he's been using. And it looks very different from what the rating agency will have you believe. I think as so I think this is the problem. Now, what is my solution or answer to that, or what should corporates do? I think we need to be very clear when we talk about sustainability. What do we think is financially material sustainability reporting, and what is non-financially material sustainability reporting? I'm not saying that we all should make the world a better place, but I'd like to have a discussion around the trade-offs, how much you spend, you know, for that versus giving me the money as a shareholder. And I'm not saying we shouldn't do that. However, I think the focus should be on what is sustainable material, financially material. And so let me give you an example around CO2 emissions. If you reduce your CO2 emissions by buying offsets, you are adding a cost to your P&L. If you reduce your CO2 emissions because you invest into new production technologies, which reduces the resource and energy efficiency of your company, you reduce emissions and improve your cost opportunities. This is what I call sort of easy versus hard ESG. The latter, that is the hard ESG, but that is what will drive change. The soft ESG is just bullshitting. You know, this is just ESG for show. And I don't think we should spend any time on that because there's so much work to do on the other side. Rant closed.
I can't let that just stay there. Sorry. I guess I'll have to respond, and I guess this is also in the interest of the panel as such. So it's true, credit ratings are more aligned. What are credit ratings? Well, a rating is an opinion about the ability and willingness of an issuer to, such as a corporation or a state, to meet its financial obligations, right? This is relatively standard across all the rating agencies. Now, it's true, as ESG ratings, they're not always aligned, but it has a lot to do with, you know, what they're trying to measure. So our scores, for example, they show an issuer's sustainability performance across 3 dimensions, based on our industry-specific materiality assessment and a rules-based methodology. Then there's other rating agencies out there that are trying to measure something else. And this is indeed relating to the topics that you've just mentioned. It's about, what do you want to measure? How do you want to measure it? How do you want to aggregate it? Yes, it's true, but some ratings just believe that environmental considerations are more important, and they exclusively focus on that. Some overweight risk issues, looking less at opportunities. Some are industry specific and others are industry agnostic. And if you just do a quick and dirty analysis, you take one company, you look at the different ratings and then say, oh, they don't align, this does not make sense. This is very short-sighted. So you should really make an effort and try to understand what they're about, and then you'll also find them useful. And just to continue on that note, there's been a follow-up study of this by the same authors. It's currently in a working paper, and they show that indeed the aggregation or the combination of all these ratings, they actually give you a lot of information, a lot of valuable information, and the study actually shows that the outperformance that ESG ratings can give you has been underestimated. But if you combine them, you can get even more. And there's loads of meta studies that show that there may not be like a strong, say, outperformance just by considering 1 or 2 ratings. I don't think anyone really promised that anyways, but there is definitely no negative effect. And if there's effect, it seems to be slightly positive. And that's based on a lot of meta studies. And I don't think it makes sense to just quote one study in this space.
But the point you're having wrong here is, what are we talking about performance?
I'm talking about financial performance as well. I'm talking about stock market, and I'm talking about financial performance. These meta studies have looked at both aspects separately.
Anyway, I think it's a problem moving the goalpost, saying we're doing a rating, but we're looking at something very different, versus being very explicit what you're targeting, right? Default ratings, you try to have a clear correlation with the default rate over the ensuing years. ESG rating, I'm not sure what you're trying to measure, right? And actually, we do this work in-house, so we just take the base data from all these guys and do our own econometric studies to figure out what is actually driving future ROICs, which of all of this stuff, right? But anyway, yeah.
Yeah, you're more than welcome to do so. And by the way, we also give you the underlying data if you like, and you can do your own analysis based on that. But we also aggregate, and for many asset managers, this is what they want. They would like to see the overall scores, and they would like to base their analysis on that. And we can spend more time on explaining the methodology and what we're trying to achieve in each and every criterion. We've just touched upon tax, which is a relatively small topic in our assessments, but still, if you'd like to invest more time, there's options to do so, and then I'm sure the application of these ratings in your investment processes will be more fruitful.
Thank you very much. That's how a panel discussion should work like, I think. So it shouldn't be always in the same direction, but also some different views on the issues. There is a hand up, please. May you speak? Yes.
Sure.
Thank you.
Thank you very much. Apologies. Yeah, my name is a bit difficult for the non-Greek, so they call me Harry. So thank you very much, both Florian and Sebastian. This was very, very interesting this morning, and the panel discussion until now. So to my understanding and view, disclosure of non-financial tax information serve different stakeholders within an organization. And both you two, from your perspective, you are part of these stakeholders. So the question is, being stakeholders and thinking of what Florian said before, and correct me, Florian, if I got it wrong, that corporate corporate taxes is only a small percentage of the total taxes or of the total tax revenues the countries have. Okay, so would have been a broader disclosure of non-financial tax information. For instance, all economic or tax contributions companies are making to the jurisdictions where they operate. Useful from your perspective, Florian, and then useful from your perspective, Sebastian?
Well, I think that runs into the difficulty that the biggest tax base of any corporate is in personal income tax, right? And, you know, the corporates can't, you know, think about what is the corporate income tax, you know, resulting from the all operating activities. So, right, this is where it runs into difficulties. The only thing they can make reasonable also other disclosures is around value added tax, which they're also paying, which generally is not disclosed in here, right? Because that is deducted somewhere else in the income statement. But so I think it is more a policy discussions around that. If, how, you know, sort of how do you use tax as a policy, macroeconomic policy tool to do, you know, to you know, direct activities in certain directions or not. I think there's very little that corporate disclosure can add here.
Well, from our perspective, I believe more disclosure is helpful. It will help us get a better idea of companies' risk exposure. And it's yet to be seen if this will really drive the needle in one way or the other. But at this stage, I think we're welcoming more disclosure.